We are back with a late summer market update. And you know, the big question all summer has been, when will Fed Chair Jerome Powell cut interest rates? Well, last Friday was a game changer. We're going to tell you why today and, of course, what it means for your money. Let's dive into it. Now, before I get into the market update, just a thank you to everyone who has subscribed to our channel. And if you are new, we'd love for you to subscribe because we are going over key financial information. There's a lot of charts today I bet you haven't seen anywhere else. So thank you very much. All right, all summer long, Fed Chair Jerome Powell, there's been a big question about when is he going to cut interest rates. The current Fed funds rate is sitting at 4.5%. It's been there all year long, and he's been wondering what's going to be the impact from the tariffs on inflation. We've been in the camp these last 3 months that if you look back at 2018 and 19 during the first trade war with all the tariffs that were put on then, inflation stayed right around 2% the whole time. So it has been our case that we may not see inflation skyrocket, and so far that's exactly what has been the case. Inflation has stayed more stable. So let's give you an update here. If you take a look at two key measures of inflation, the Consumer Price Index, known as the CPI, and the PCE Price Index, which is the Fed's #1 preferred measure of inflation, you will notice that actually, we can see a time when this did skyrocket back in 2021 and 2022, but that is not happening this time around. These things have been in a stable range here for the last couple years. There just isn't a sign here that this is skyrocketing. But that's not the only chart we want to show you on this topic. If you go back basically 50, 60 years, almost every massive surge in inflation, you have seen oil prices, energy prices, all explode to the upside. That happened back in 2021 and 22, when oil went almost to $125 a barrel. Well, take a look on the far right and you will see that oil has been declining lately. It was just at $75 a few months ago. It is sitting at $64 now. This is near the lowest level in the last 5 years. But that's not all. We have commodities in general. So this is a fund, an ETF. PDBC is the ticker symbol that tracks a basket of energy, precious metals, agricultural products, and industrial metals. And once again, over on the left-hand side, you see that soared back in 2021, 2022. Over on the right, this is very close to 10-year lows. That is good news there. If we look at freight costs, we all remember back in 2021, 2022, the pictures and videos of all the ships off the coast of California. Freight costs were skyrocketing, and you can see that once again here on the left-hand side. And then on the far right, look at freight dropping like a rock, and once again, very low levels today. Average hourly earnings, you know the drill here on the far left. This went up to about 6% in 21, 22 when companies were having a hard time getting people to come back to work. Over on the right, 3.91%, which this is in a good range, 3.5% to 4%, because we want workers to have their wages grow year over year faster than inflation. And it's doing that, but it is not going up at an out of control pace. So when you put all of those things together, you get the picture that there is just not sign that inflation is something to be overly concerned about at this time. And so that's what Powell said last Friday at the Jackson Hole meeting. He said he basically teed up a rate cut for September. And right now the market is pricing in that there's going to be between 2 and 3 cuts during the back half of the year. This supports the market, and it's why Friday the market soared after Powell had this press conference, and the markets, as we record, are very close to their all-time highs. So that is a very good piece of news for the back half of the year. That's critical for your money. Now, speaking of the Fed and rate cuts, there have been some clients who have asked the question, hey, the market's near all-time highs and the Fed's cutting rates. What does that mean for forward returns for the stock market? Have we already seen the gains? Well, we went and wanted to search out so that we could get an answer. So what we're putting up is a chart, and there's a lot here. We're only going to look at the date of the rate cuts. And this is since 1980, when the Feds cut interest rates with the market within 2% of an all-time high. And on the far right side, over the next 12 months, what were the returns? And what you'll notice is that every single time they're in green. The average return of almost 14% over that time. That's better than the markets. They average about 8.5%, 9% in a normal year. So what this has meant, and these are a lot of occasions, by the way, when this has happened, 16, 17 occasions, every single time a year later, the stock market was higher and on average by 14%. That means there can still be some big gains ahead now that the Fed is at a place where they are going to be cutting interest rates. Now, speaking of inflation, another fantastic chart that takes a look at the last 30 years and looks at the loss of purchasing power that one has gotten with the dollar, because over time with inflation, it eats up the value of your money. One of the reasons that we say you want to be investing, and this chart really hits that point home. So over that last period, the last 30 years, the purchasing power of a dollar has dropped by almost 53%. This means if you put that money under your mattress, that has not been a good decision for you. On the flip side, if you invested in the S&P 500, and this is looking at the total return you would have made in that time after inflation is accounted for, 874% returns. That is remarkable. So a big question we get asked, and we're asked a lot with the inflation years that we had over the last 4 or 5, hey, what does investing in stocks do? Well, this chart hits home that there probably is nothing better. And I can bet there's not been a better return in the asset classes people have had an option to invest in over the last 30 years. Stocks have been the best bet. And so this chart hits that home. That's a key one for you, no doubt. Next up, we want to give an update on the outlook for corporate profits. One thing that we try to pound home in our videos is that in the long run, stocks go where corporate profits go. You've seen this if you've been watching our videos for a while. This shows back in 23, corporate profits came in about $220 for the S&P 500. 24, it jumped up to 246. Then look at 2025. There has been a move up in the last month and a half. And this is companies coming out with their earnings and raising guidance for the rest of the year. Tech have had very good earnings and raised their guidance on the back of AI. That is a positive development. And then look up at the top for 2026, the same thing is happening, meaning expectations now are that corporate profits are going to jump significantly. Look at the gap between 25 and 26 there, from about $267 up to what, 303, 304. And that red line, which has been since early 23 to now, the next 12 months, that has been consistently going up. And we like to point out that in this time period, 23, 24, and 25 so far, there have been some sell-offs along the way, 10%, 12%, 22, 23%, and yet the market's always recovered quickly. This is the biggest reason why they're following profits higher. All right, next chart. Now, this is looking at consumers, and this is through Bank of America. it takes a look at where were checking account balances by your income level pre-COVID versus now. So 100 is basically where everyone was pre-COVID, and the green dotted line is inflation adjusted. So accounting for all the inflation that we've had, the green is where you would be today accounting for that. And the good news here is that even though all income levels are down from their peak where they were in early 21, where at that time, a lot of people had extra money in their checking savings accounts from all the stimulus programs. And if you had a job, you weren't doing as many things, vacations, ball games, etc. So your checking account, savings account balances were rising at that time. But the positive takeaway here is that even today, all income levels have more money in their checking and savings accounts, adjusted for inflation even, than they did 5 years ago. This means that consumer spending can continue to be strong. We heard from Visa, MasterCard, and American Express, and we talked about this in our last video. We heard from them in late July, and they all three said consumer spending continues to be very good. They have not seen any weakening from the consumer. We really like to see that. We care a lot what those companies are saying for their outlook. All right, our last chart here takes a look at companies in the S&P during their earnings calls. How many of them are talking about recession? And this goes back a number of years here, but what I want you to focus in on the right-hand side, first quarter for 25, so these were in calls in April and May primarily. Notice a lot of companies were talking about a recession. They don't have to be calling for one, but they're talking about, hey, a recession is possible. And you can see that number soared from late last year because of the tariffs. There was a lot of uncertainty there. We stayed pretty bullish. And you can see here companies are back to their bullish ways, because this time around in July and August so far, you can see that red arrow. We have not had many companies at all mention recession. That has kind of disappeared as a possibility. That is good evidence that during the back half of the year here, companies expect to do well, and that can drive client portfolios. So what's the key takeaway? Well, at Jackson Hole, Fed Chair Jerome Powell teed up a rate cut for September. When you take that and combine it with the charts we've showed you today, the consumer is still in good shape and the outlook for corporate profits has never been brighter. So thanks for watching our video. And if you are new to Centera Capital, don't forget to subscribe to the channel and head over to our webpage, centeracapital.com. You can reach out to us and set up a call. We have a 3-meeting process to see if we are a good fit. And if you're not getting these kind of market updates from your advisor, we'd love to talk to you. Thanks for watching. Take care.